This call is being recorded.
All right, folks, welcome to the Josh Scanlon podcast. I cannot tell you what a privilege it is to be on this call here today with someone who's a mentor to me in so many untold ways, Elaine Floyd from Horse's Mouth. And this is going to be wonderful. So Elaine is literally one of the three people I go to on all things Social Security. Larry Kotlikoff from Boston College is one, or Boston University is one. Alicia Manila, I don't even know how to say her last name, from Boston College is the other, and then Elaine. So those three people right there are the people I talk to. And I have already interviewed Kotlikoff one time, and that was great. But now I get to talk to Elaine, and I cannot describe how excited I am to bring this to you. And the nice thing is Elaine also is an expert on Medicare planning as well. And like when I do my YouTube videos on Social Security, you think Social Security is complex. Look at Medicare and you literally want to kill yourself because it's insane. And so I don't know how Elaine keeps track of all this because it's mind-boggling complex for Social Security, but then Medicare 10 times. But listen to this conversation because Elaine, it's just a privilege to have you. Welcome to the podcast. And I am so excited you're here. So thank you for joining.
Thank you. Thank you so much for having me. I'm really happy to be on the line.
Oh, yeah. No, it's fantastic. And so, Elaine, just tell us, you'll start just who you are, your background. I know you got a psychology degree from UCLA 2 years ago or something like that. Start by telling who you are and how long you've been doing this stuff and the whole kit caboodle, if you will.
Okay. Are you ready? Are you ready for a monologue? Here we go. So yes, going way back, I did get my bachelor's degree in psychology from UCLA. My first job after college was as a social worker in South Central Los Angeles. I got married right out of college. I had a couple of kids. And then after 11 years of marriage, I got divorced. And at that point, I had to figure out a way to support my family, support my two kids. So after much soul searching, I became a financial advisor. This was back in the 1980s. I was a stockbroker for E.F. Hutton and stayed in the business. I started the business in 1981. I left the business in 1987 to become a freelance financial writer. So basically, I took the knowledge that I had gained from being a broker and I let the company train me. And then I combined that with some writing skills that I had honed over the years and hung out my shingle as a freelance financial writer, specialized in retirement planning. And I had a very keen interest in Social Security even back then. I was in my 40s. What I had been telling my clients about Social Security was don't count on it. That's what we all told the baby boomers, don't count on Social Security. And that means you have to save your own money. Well, then I started doing some research on Social Security. And just because I thought, all this money is coming out of my paycheck. Yeah. Shouldn't that be going for something? Certainly there will be something there for me. So anyway, I started studying it. In 1983, they passed a bunch of amendments that changed the system quite a bit in our favor. And I knew that financial advisors didn't know this stuff because I didn't when I was a financial advisor. The retirement age was raised from 65 to 66. The annual delayed credits that you got from delaying your benefit to age 70 increased. They used to be about 5% a year, and then they increased it to 8% a year. So there were all these things that I knew that people didn't know. So I started writing about them. I joined Horse's Mouth. Horse's Mouth is a company that trains financial advisors and provides information on tools for advisors to help their clients. Yeah. And when I joined the firm in 2008, which was the year I turned 62, we decided to launch this training program for advisors on Social Security, and I learned so much about it. Now, all of my life, when I have made these career decisions, they have related to my own life. In other words, I became a financial advisor to begin with because I wanted to learn how to, save and invest money. Then I started specializing in Social Security at age 62 because I wanted to learn how this thing works. And then Medicare at 65. So here I am all the way at age 72. And I say that I am the poster child for maximizing these benefits, because here's what I did. When I really learned about the system and all the different strategies. And by the way, the two mentors that you recommend, Larry Kotlikoff and Alicia Manel, they are mentors of mine as well. I studied a lot of their material in putting this program together. So here's what I did. At age 62, we developed these calculators that show what benefits would be over your lifetime if you claim at 62 versus age 70, or really any two ages. You can put in the calculator and you can see what that break-even age would be. In other words, if you start benefits early, you get more checks but in a lower amount, versus claiming later, you get fewer checks but in a higher amount. So all it is math. You just run out the numbers and you say, okay, at what age would you have received more benefits by claiming later? And it's usually around age 78 or so. Well, we put together that calculator and a number of other calculators. And meanwhile, I'm having birthdays. And I know not to claim at 62. For one thing, I was still working and I would have been subject to the earnings test. So I knew that was the wrong thing to do. Right. I also learned about this strategy for divorced women. If a woman has been divorced, if a woman, anybody, a man or woman, was married more than 10 years and they are now divorced, they may be able to collect benefits based on their former spouse's work record. And it doesn't affect the other spouse in any way. It's a benefit that divorced people can get if they were married more than 10 years. Now, there are certain conditions and rules associated with it. In my case, I could go in at age 66, and that was my full retirement age, and apply for my divorced spouse benefit, which would equal half of my ex-husband's primary insurance amount. And his PIA was around $2,200, so that gave me basically free money of $1,100 a month while I was waiting for my own benefit to grow to age 70. And then another little thing happened, which worked to my favor, not in his, unfortunately. He died a year later. So at my age 67, he died. And when his death was reported by his widow, my divorced spouse benefit automatically converted to a survivor benefit, and the amount doubled. So now at this point, I could get 100% of his PIA, or $2,200 a month. And then
Social Security
that to age 70.
Elaine, did they do that automatically, or did you have to do something for the increase from the spousal to the survivor benefit?
In my case, it was automatic, but I should caution people that don't ever assume anything's going to be automatic by Social Security. We've seen many cases where people have not gone back for their spousal benefit once they became eligible for it. So we always say to stay on top of these things. And, I definitely stayed on top of it and noticed that, that it was automatic in my case. But yeah, people need to stay on top of these things. So point is, I was able to, the system really worked in my favor, and really knowing those rules helped me a lot. I should say here, not everyone can do what I did. It was such a good deal that they changed the rules a few years ago. And so people who were born after starting January 2nd of 1954, so anyone born in 1954 or later cannot do what I did, cannot take that spousal benefit and then switch to their own benefit. If you were born in 54 or later, when you go in to apply, you will get the higher of your own benefit or your divorced spouse benefit or your spousal benefit. So I just want to put that out there for people who still are eligible for that strategy. If you were born in 1953 or earlier, if you were married more than 10 years, if you are currently unmarried, you get down to your Social Security office and apply for that divorced spouse benefit.
Or if you're currently married, I know it won't be divorce benefit, the same thing, right?
Right. If you're currently married, you can get a spousal benefit based on your current spouse's work record. The
As
other
long
spouse
as you
does
were,
have to have filed.
I was going to say, as long as you were born before January 2nd, 1954, the same thing's applicable for married couples as divorcees. But no, you're
Yes.
getting ready to say something pretty important, so I interrupted you there.
Well, I just wanted to say that the other spouse must have filed. So if you're, if you you've reached full retirement age, you want to get your spousal benefit, your spouse must have filed for his benefit in order for you to get that spousal benefit.
So if I get this question, my spouse is 61, I'm 66, that won't fly then because your spouse hasn't filed for the benefit.
Correct.
If the spouse was 62 and filed early, let's just say you and I are married, Elaine, and you're 66, I'm 62. I file early, so my benefit is reduced. But because you were born before 1954, you could file for your spousal benefit. Would it be half of mine at my 66 years old, or would it be half of mine early filing at 62? Does that make sense what I'm asking?
It does. And it would be half of the age 66 amount. Okay. So let's say your PIA, your age 66 amount is $2,000 a month.
Right.
You file early, so you're getting $1,500. My half would be half of the $2,000.
Okay. All right. So you don't get penalized for me filing early. Okay. Gotcha. Okay. Cool.
Yeah. Except now we get to survivor benefits. And I don't know if we want to talk about those now or if we want to finish up on spousal.
No, let's do spousal. Let's go back to your history with your own benefits, with going from spousal to survivor, and then I just jumped in there and interrupted you for the 20th time. So
that's good. Okay, so yes, so I took my spousal, then it converted to a survivor benefit after a year. Now, in my ex-husband's case, he had filed for disability benefits when he was about 64.
Okay.
And I should mention that at the time that he filed, I got a call from his Social Security worker telling me that I could now file for a divorced spouse benefit. And he said it was just a courtesy call, that they do that whenever they have, whenever the person they're taking the application from has a contact information for the ex-spouse. And my ex and I were on good terms. So he called me and he said, you can get your benefit now. I knew the rules. I knew that, I was 64, I was still working, and would be subject to the earnings test. And so it wouldn't have done me any good to file for my benefit. But I just want to mention that. And one other thing, that sometimes communications from Social Security can be a bit misleading. So here I am, age 66, I filed for my divorced spouse benefit. About, I don't know, somewhere 6 months or something after that, I got a letter from Social Security saying, if you switch to your own retirement benefit, you can get more.
Yes, right. What the hell? Okay.
What the hell? That's right. So that would have ruined the entire strategy. The whole strategy was to take the spousal benefit and let my own benefit increase by 8% a year to age 70. So that's why I tell all of my financial advisors, ask your clients to show you all the communications they get from Social Security, because they can be misleading sometimes.
So, Elaine, you received a letter from Social Security just 6 years ago now, so that's in 2012, that said you could now, because you're age 66, get more than your spousal benefit because it's only half of your ex-husband's PIA, and it says switch to your own benefit. And man, do they send that out to most people in that thing? I mean, because you're Elaine Floyd, you're king of the world of this stuff. But, Mrs. Smith down the street, Yeah,
I do. I know. It's frustrating. And I think, so here's the thing. Social Security is an automated system. And parts of that automated system work excellently. That is why they are able to process these many, many millions of applications and send the checks, and they hit the bank account. Considering the size of this program, there are very, very few administrative problems. But, the downside of automation is what the system does is in an effort to really help people,
Right.
they'll
Exactly.
look at the possible benefits and say, hey, you could get more if you did this. So.
Well, speaking of Kolikoff, he had a big article not too long ago, and I think I might have found it through Horse's Mouth, actually, about how the IG report, the Office of Inspector General, said they underpaid like $140 million to survivors. And I know that it's not nefarious. It's not like they're trying. Well, I frankly, I don't know that, but my presumption is it's just automated, like you said. But
let's talk about survivor benefits, because it's huge. And I'm sure there are a lot of widows and widowers on the line listening to this.
Yep.
that need this information. So here's what happens. If you are a widow or a widower, let's say you were married and your spouse died during the marriage, or let's say you were divorced, you were married more than 10 years and your ex-husband died after the divorce, then you qualify for divorce spouse survivor benefits. That was my case. Yeah. So where was I?
Talk about the widow.
So you qualify. So you qualify for this benefit starting at age 60, and what the benefit is the amount that your deceased spouse would have received or was receiving if he was receiving benefits during, at the time he died. But if you claim it at age 60, it's going to be reduced. You're going to get 71.5% of that amount. So what Social Security workers often do in an effort really to help, honestly, they're trying to help, but widows will go in, they will hear that they become eligible for survivor benefits at age 60. They'll go in and they'll say, what should I do? Should I take my survivor benefit? And the Social Security worker wants to get those benefits started. Their job is really to pay people the highest amount that they are eligible for at any given time.
Right.
And so they will encourage the widows to apply for that survivor benefit at age 60, not really taking into account that over that widow's lifetime, she's going to receive much lower amount of total benefits. And the other part, and this came out in that OIG report, is coordinating the survivor benefit with her own retirement benefit.
Yeah.
So let's say she worked maybe at a low paying job and she has a benefit on her own record of let's say $1,000.
Yeah.
Okay. Let's say the survivor benefit would be $2,000. All right. So if she applied for that survivor benefit at age 60, it would be reduced to what is that amount? 2,000 times 71.5%, whatever that is.
But because she applied for this, okay, gotcha, right on. Okay. Mm-hmm.
Right, yeah, so it would be 71.5% of the 2,000, and she would never really be able to take advantage of her own retirement benefit.
Right, because it's less than. Mm-hmm.
Exactly. So the better strategy would be for her to wait to age 62, file for her own retirement benefit, take that for a few years. When she turns full retirement age.
Hold on, you said the better strategy, and then we cut out for just 1 second. So go back to say the better strategy would be for
her to wait 2 years, at age 62, file for her retirement benefit. It's reduced, but that's okay. Right. Because when she turns 66 or full retirement age, then she's going to switch over to that full survivor benefit.
So
and receive that for the rest of her life.
Survivor benefit is $2,000 if she takes that at her full retirement age of 66. So she goes to Social Security because she got the letter. She's 60 years old now. So we'll just say it pays them $1,400 a month in survivor benefits at 60. But her benefit is only $1,000 on her own record. So she's saying, hey, I get $1,400 now, or I could wait till I'm 62 and only get $1,000 then. And so she's like, I'll take the $1,400 now. But if she waited till she's 62, she'd get her own benefit of $1,000, and then in 4 short years, that own benefit would double to her survivor benefit at 66.
Yeah,
I mean, it's hard to explain numbers on a telephone call, but I cannot tell you how many. I cannot just express the heartbreakingness I feel when I see these YouTube comments on my channel about survivors, widows, and divorcees. And again, it's not that Social Security is doing anything wrong. They're trying to help for the minute today. You go down there today, your best bet is X. But 4 short years, if they just, it's sad. And yet when it can't be fixed after that. It just breaks your heart. And I don't know. Anyway.
Yeah. One other thing I want to mention about survivor benefits, and that is that the age, I know we're going kind of deep here, but I think people can follow along. The age at which the husband filed for his benefit determines that survivor benefit.
Yes. Yeah.
So let me give an example here. Let's say you have a husband and a wife. They're both still alive now. They're both 62 years old, and they want to grab those benefits early. So he files for his benefit at age 62, and then he receives that. And let's say he turns 70 and he dies. Her survivor benefit, so she then can switch over if she's receiving her own smaller benefit. At that time, when he dies, she can switch over to his benefit, the amount he was receiving at the time of his death. If he claimed early, she's going to get less than if he had waited. So that's why we always say, well, I mean, we do tend to generalize, and it does sound kind of sexist, but the truth is men usually die before women. Yep. And so we do recommend that if the husband is wondering when to claim his benefit, he should ask the wife, because after he dies, the age at which he claimed is going to determine what her benefit is what her income will be the rest of her life.
Yeah, and I'm 4 years older than my wife. My wife has sacrificed her career to raise our 4 kids, and so inherently, her benefits will be based on my record, no other way around that. So for me to file early, knowing that I'm going to die first because I'm a man and I'm 4 years older than her, would reduce her, her benefit when I die. And
yeah.
And
it's
that's
really the most loving thing a husband can do,
Absolutely. And the funny thing is, I was just actually going over, I'm not sure how much you're familiar with the military, with the survivor benefit plan, but it's like Social Security also has a cost of living adjustment, as does the military survivor benefit plan. And a lot of people are down on the military, on pensions, generally speaking. I don't know why, but anyway, it does adjust with inflation for the military, the surviving spouse, again, generally a woman. And, that's a price tag that's awful hard to quantify, knowing full well that it will keep up at least, somewhat with cost inflation. Maybe not dollar for dollar, but it's certainly better than just locking it in when you're 62 years old for the rest of your life. It does adjust each and every year with some kind of, bonus, that's for sure.
That's right.
Yeah. Elaine, so what? So now your experience was you were married. What happens if you remarried at 63, or what happens if you remarried at 65? Any of these strategies change? So we went from you with your spousal benefit to your survivor benefit to your own benefit. If you remarried at in your 60s, would any of that change?
So if I had remarried while I was receiving the divorced spouse benefit, then that benefit would stop.
Oh, okay.
So you can't receive a divorced spouse benefit if you're married. However,
regardless of when you got married?
Right.
Okay. Gotcha. Okay.
So now, but survivor benefits are different. So now, a year after I started the spousal benefit, I switched to the survivor benefit. I could have remarried and it wouldn't affect my benefit. And the reason was that I was over age 60 when I remarried.
Gotcha.
So that's the key thing to remember. If you are receiving a divorce, if you're eligible for a divorced spouse benefit and you remarry, that benefit will stop. But if you're eligible for a survivor benefit, you can remarry after age 60 and it will not affect the benefit. We had a woman, one of my first cases, she was 57 years old when she remarried and didn't realize she had been widowed and didn't realize that by remarrying before age 60, she could no longer be eligible for survivor benefits based on that first husband. So she asked her advisor, could I get divorced and then apply for the benefit and then remarry my husband after age 60? And I actually called Social Security back when it wasn't such a long wait time on the phone, and asked them this question, and they said, yeah, they said, we just look at the rules. You know, if she comes in and she's not married and she applies for that survivor benefit, we're going to give it to her, and we're not going to check back and see if she remarried the same guy. You know, see if she's gaming the system that way. But anyway, that's kind of why my blanket advice to anyone who's in their 50s, particularly late 50s, and you're contemplating remarriage, just have a long engagement and plan that wedding for after age 60, because you never know, you know, even if you are divorced and your ex is alive and kicking, you never know what can happen.
Well,
so
you
just to be on the safe side.
A great YouTube video to do, and I can see the title now. In your late 50s, don't remarry yet. Don't remarry yet, or something like that. That's, I mean, frankly, that's a great. I mean, it's game of the system. I mean, the rules are the rules. You play attention to the rules, and it's kind of like people say about the tax loopholes. You're like, it's not a loophole. It's a rule. It's a rule. I'm playing the rules as they are, and I'd be foolish not to. I mean, if you're 59 in 8 months, and you're about to get married, you might want to just wait 4 more months and have a longer engagement. Nothing inherently immoral about that in the least. I don't know. Some of the comments I get about the Social Security is wrong. It's weird. I'm like, okay, that's your morality. That's fine. But given what I know about surviving spouses living off $800 a month, frankly, they want to play the system for what it's worth. I don't care. I just, at the end of the day, there's many, and they're all women. Oh, not all. The vast majority are women, and they're 68 years old, living on $900 a month, and that doesn't make me feel good as an American, knowing that that's happening right now. And it happens a lot, actually. All right, so enough of my morality there. I was going to ask you about if you're I just was going to ask you something. If you're a survivor, if you're a survivor and your spouse, if he died before he was taken. So again, you and I are married. You're 66. I'm 58. So I haven't taken benefits now. I die. What is your benefit? Would it be my PIA, or what would your benefit be?
It would be your PIA, the amount shown on your statement, that you would have received if you had claimed at your full retirement age.
Okay. Even though I'm not at my full retirement age, they're going to assume I would have waited to claim.
Exactly.
Okay.
They're going to assume that. Yeah.
All right. And then second on this, I'm curious what I think about it. If I was 67 but I haven't claimed yet, would they just say, they would not say, we assume you'd wait till you're 70. We're going to pay your benefits at 67 with the 8% delayed earnings credits for that 1 year, or would it go back to PIA? Does that make sense?
Yes, it does. And you do get the credit. So it's the amount that you would have received on the date of your death.
Okay.
If you were to have applied. Yeah.
So the amount you would have received on the date of your death, either your PIA or the delayed earnings credits for that year, or if you filed early, it'd be that amount. And then, okay, gotcha. Then if your survivor filed early, she would get a reduced benefit. Okay. So if I died at 62 and you were 66 and I died at 62 having filed, all right, so now I'm taking 25% reduced benefit. I die. What do you get at your full retirement age? Do you get you get your full benefit off of my reduced benefit? Does that see what I'm saying?
Yes, I get the full benefit off of your reduced benefit.
Okay.
And to complicate matters even further, there is a special minimum. So if you file at 62, you're getting 75% of your PIA.
Right.
The special minimum for survivors is 82.5%. So that's how that would work. If you file at 62 and then the next day you die and I'm 66, I'm going to get 82.5% of your PIA. Now, if I'm only 64, it does get very complicated, the math here. But if I were 64 when you died, I could, if I claimed that survivor benefit at the time that you died, that reduced amount would be further reduced.
Okay.
Because I'm claiming early. But I could wait. And that is one of the strategies. That's one of the very, very important strategies, is knowing when to take that survivor benefit. As I said, if I were to go to Social Security, they would say, here, start your benefit at 64. And that would probably not be the best strategy for me. It would be better to wait.
Elaine, can I ask you I hate to throw these Q&As at you, but I'm just curious, and it's got my interest peaked here. So if I'm 58, just go, no survivors or anything. I'm just 58 right now. And I get this question a lot too. And I'm thinking about cutting out from work. So I got my Social Security statement. But that assumes I'm going to make the same amount of money I'm making now until I'm 66. Assume my FRA is 66. Is that right?
That's correct. And that's a great, great question. It comes up all the time because people are saying, hey, I want to quit. I'm looking at my statement. It shows that I'm going to get this amount of money if I claim it at full retirement age. People need to understand that that estimate on that statement presumes continued earnings at the same salary until full retirement age. And so there's a very, very good resource on the Social Security website. It's called the Retirement Estimator. And if they just go to ssa.gov/estimator, and you put in your information, it taps into your own earnings record. And then you can put in your own retirement date and it will give you a revised estimate.
And you could put it in with zeros if you say, I'm cutting out, I'm not going to work, just go fishing for the next 5 years. You can do that too?
Yep.
Okay.
Yep. So you would it asks for, your projected retirement date. And if you put in December of 2018, then it would presume zeros for, for the next 6 years, whatever. And then it would recalculate the benefit based on those lowered earnings. What we have found in just the examples that I've run is that it knocks it could somewhere between $100 and $200 off of a month off of the benefit. So that's just kind of a guideline that people can consider. Now, there's a flip side to that too. We get people that say, I'm going to work until age 70 or 75 or 80. How is that? How is my benefit going to be different there? Yeah. And so what happens there is, so the amounts on the statement presume continued earnings till claiming age. Okay. So the age 66 amount presumes you're going to stop working at 66. The age 70 amount presumes you're going to continue working until age 70.
Oh, and I did not know that. Okay, so okay, that I just learned a lot here already. Okay, cool.
Yeah, good. Yeah, and the other thing is that as long as you are working and paying, and that 6.2% FICA tax is coming out of your check, your earnings will continue to be reported to Social Security, and your benefit amount can be adjusted. And so I have seen that in my own case. When I say I'm the poster child for maximizing benefits, it's for 3 reasons. 1, I delayed my benefit to age 70. 2, I took advantage of those spousal and survivor benefits. And 3, I'm continuing to work. And I had some low earnings early in my career, so I'm replacing those low earnings with higher earnings now. And every year, I get around March or so, when my earnings are reported to Social Security, I get a notification that my benefit, I think this past year, went up about $29.
Because of your earnings for 2017 replacing one in 1982 or something like that.
Exactly. Yep. So the point is, it never pays to stop working. In other words, your benefit will never be hurt by working. You may not get quite the return on investment, your 6.2%, and some people do argue that once you turn a certain age, that they should stop taking that 6.2% out. Well, that's a political argument, and you can argue that all you want. But the point is that if there's room in your earnings record, but even if you're a maximum earner, most recent earnings count for more than earlier earnings. So everybody who continues working is going to get a little bit of an adjustment in their benefit. May not be that much, but it will be something.
And even if it's, let's say you made a lot of money, as a 28-year-old, I don't know, whatever, you're working for Google, back in 1981. I mean, just hear me out. And now you're just waiting tables at the local diner. You're still paying the 6.2%, but your earnings this year, which are lower, they won't even be counted because your top 35 are always your top 35. I mean, it'll never be reduced because you're continuing to work.
Exactly.
What How about now? Let me ask you a question. So, how about the inflator? Like on the Social Security website, it gives you the inflator to 2017, I think is the last one. And I think it's like once you hit 60, they no longer give you the cost of living adjustments or something like that, or not the cost of living adjustments, the inflator. How does that work for you specifically?
Oh, it's complicated. So when, oh boy, when your benefit is officially calculated at age 62 using bend point. Um, See, I don't know if I can even take the time to describe how that formula works here.
I got tons of videos on that, folks, on the bend point. So, Elaine, you don't need to go into that. I've done that.
Okay. All right, good. But the point I want to make is that prior to age 60, those bend points are being adjusted upward based on increases in the average annual wage index.
Right.
After age 62, your benefit is being increased, your PIA, which is whether or not you've started your benefit, I should say. But once your PIA has been calculated at age 62, it's going to increase by annual cost of living adjustments.
Gotcha.
So in other words, before 60, the increase is based on wages. After age 62, the increase is based on prices. And historically, the wages have increased faster than prices.
Okay.
So that's just, something.
But if you're 60, even though the Social Security inflator says 1 at that age on that, they have this table, you know what I'm talking about? And it starts from 1970.
Oh, yes. Right. The indexing. Yes.
Exactly.
The indexing of the earnings. Right.
So
after age 60,
Go ahead. After age 60, what?
After age 60, that your earnings count at their nominal value. See, prior, like if you take my 1982 earnings, which were, I don't know, let's say 30,000, let's say, they would be indexed to bring them up to, the current levels. And so the indexing factor might be like 5 point something or other. That would bring that, right? So what you're saying is that once you turn 60, then your earnings count at their nominal value. That indexing factor is 1.
But they still have the cost of living adjustment once you hit 62. So, okay.
Exactly.
Good, because I have that question a lot. What if I stay till 70? Am I basically losing to COLAs because they're using that 1 for the indexing number? And Frank, I said, I don't know. And that's why I knew I was going to have this conversation with you. I said, I can't imagine. I know it's a COLA. I just don't know exactly, when that kicks in. So that kicks in at 62.
Right.
Okay, cool. All right, so good.
So again, let me say one other.
Yeah, go ahead.
One other thing about my own personal situation. I was so curious about all this but what sparked my interest really back in the 80s was how am I going to know how much I'm going to get? How am I going to know that it's figured correctly? And is there anything I can do to change it? To raise my benefit amount. So those were the questions I started with. And that's what led to all of this work that I've done on this. And so when I turned 62, the year that my PIA was calculated, I calculated it manually. I took those bend points, I took my earnings, the indexing factors, all of that. I figured all that out manually, literally on a piece of paper with a pencil.
Right.
And then I put it into an Excel worksheet and calculated my PIA. Every year after that, I have updated my earnings record and I have added the COLA. And so when I went to apply for my benefit at age 70, it was within $1 of my estimate.
No kidding.
Not kidding.
And Social Security had all your numbers correct. They didn't screw anything up in terms of, we forgot in 2006 to put your income in there. They had it all right to $1 of what you had. I mean, I guess I'm more shocked, not on your numbers, Elaine, but on their numbers. That they
on their numbers.
Right.
And speaking of that, I should mention that in the 90s, I do remember getting my Social Security statement and it showed a 0 for, I think, my 1993 earnings. And so I called Social Security and got it corrected. All you have to do is send them a copy of in my case, a copy of my tax return because I was self-employed. And I think I had applied for an extension that year or something. Anyway, it had not gotten reported, and it was an easy enough matter to report that. And while we're on the subject, I want to tell everybody to go to ssa.gov/myaccount. Maybe, Josh, you've already talked about this, but open an account, and that way you can check your earnings record every year.
No, that's one of the things from your, so you have the things on Horse's Mouth, the Savvy Social Security Planning, the webinar, and I do that a lot actually. I use that literally verbatim. And you might remember I emailed you. I said, hey, I just want to make sure it's not copywritten, because I bought the program. You're like, no, go crazy. So I've done that. And I said explicitly, go on to that thing and log in to check your earnings records, because if they screwed it up, only you are going to be hurt from it. They're not going to be hurt from it. It's only be you. And, to be perfectly honest, it's the government. I mean, and I don't think they're doing anything, like I said, nefarious, but they don't know you from the guy down the street. They just do what they're told to do. And
Right. It's just mistakes. And there's one other reason to open an account that this is a little scary. And I wrote this up recently in a newsletter, Josh, maybe you read this, but people are opening accounts with stolen Social Security numbers. After the Equifax hack, basically all of our Social Security numbers are out there. And we have seen cases where people have gone to ssa.gov/my-account. They answer all they put in their Social Security number, and it comes back saying, we already have an account with that Social Security number. And what people are doing then, they open the account, they wait until that person would be 66 and a half, and then they apply for benefits. And they have those benefits sent to a bank account.
Yeah.
And so it's bad stuff. I mean, I hate to scare people, but got to protect yourself here.
No, I mean, you pray for the best and you plan for the worst. I mean, that's what you have to do, because the facts are this is happening. That just kills me, Elaine. So I want to go back to working again. I think this actually gets overlooked, because everyone thinks I'm retired at 60 or something like that. And I'm like, yeah, you might retire from some crappy old job, but you might go and do something of interest where you're still earning money. And if you were to do that, at the end of the day, you still could add to your Social Security benefit, and you're living proof of that. I mean, your benefit increased because of your labor that you're still kicking in. That's adding to the 6.2%, and Horse's Mouth is kicking in 6.2. So your benefit literally has gone up, even though you're well above full retirement. Not well above, but you're above full retirement age. You see what
I am well above. Yeah, and even though I'm currently receiving benefits. That's the other thing. People think, what? You can get Social Security and still it counts and it's going up every year? And yes. And the reason is exactly that. Both my employer and I are paying 6.2% into the system.
All right. So another thing I get, men all the time actually, frustrates me, is like, I don't plan on Social Security. It's a Ponzi scheme. It's going bankrupt, blah, blah, blah. And I just drives up the wall, because it's not going bankrupt, and we can call it a Ponzi scheme any way we want, but it is a real live thing. It's out there. It's not the Easter Bunny. It does exist, and you are going to get a benefit from it. What do you say to those naysayers who say it's a Ponzi scheme, it's going bankrupt, it's theft, blah, blah, blah? I mean, I don't mean to get political, but just the basics.
I know.
Yeah.
It's on everybody's mind, so we have to address it. So here's what I say. Number one, this is what we know, or what the Social Security trustees have projected. They every year they put out a report that projects the system's financing over the next 75 years. And what they are projecting currently is that, right now there's $2.8 trillion in the trust fund, and that's because they have been taking in more taxes, more FICA taxes, more contributions than they've been paying out, because the baby boomers are still, front loading the system. So there's $2.8 trillion sitting there. But beginning about now, they're having to pay out a little bit more than they're taking in taxes. So what they're doing is starting to gradually draw down that trust fund. Well, in 2034, they project that trust fund is going to be exhausted. However, there's still going to be the payroll taxes coming in. So starting in 2034, they will be able to pay only the amount that they are taking in taxes, which equates to about 77% of current levels. Mm-hmm. So that's what they are projecting. And every year when they release this report, they appeal to Congress to please do something to strengthen the system. And Congress, of course, never does anything. Well, I shouldn't say that. Congress people all the time are submitting proposals, various proposals. for Social Security reform, and usually they just get referred to committee and then they never go anywhere. So that's where we stand now. There are people who think that the whole system is going to be abolished. They think that it can't sustain itself. And I would just say to those people, there are some people whose mind you will never change. I mean, they just want to believe that. Right. And I would just say that you have to do what's best for you. If you think Social Security is not going to be there, then you better start saving. You know, you're going to be having to take care of this yourself. So yeah, the only way that people can, I think, get themselves in trouble is those people who want to grab those benefits at 62 because they think the system's going broke. Yeah. And what they are going to end up doing probably is hurting themselves, because they will end up, you know, with lower lifetime benefits. Even if benefits are cut in 2034, they're still gonna have, you know, a lower benefit amount. So they're taking the risk. That's what I just say. If you want to file at 62 because you're afraid the system will go broke, you're taking the risk that it won't, and you know, you'll end up with a lower lifetime benefit.
And the corollary of that is the trustees even saying, what, up until 2091, even at that point, they're still going to be able to pay like 71 cents on the dollar or something like that. So, I mean,
yeah.
That's not bankrupt. Bankrupt means it literally cannot pay anything. And, you know, literally, as we see here today, the worst case scenario is you get 70 cents on the dollar 2034. And then if you survive till 2091, you get 71 cents on the dollar. I mean, that's not great, but it's a heck of a lot different than it, you know, imploding. I don't.
Yeah.
And just we only got I got to let you go here in just a couple of minutes, because I like I said, I got 1 hour before the stupid system cuts me off because I'm so cheap I don't pay for the upgrade. One of these days I will. Talk about taxes. I think one thing gets overlooked a lot, and I actually had written a book on the beauty of the Roth IRA combined with Social Security. In fact, I call it the perfect retirement plan. Roth IRA and Social Security, because essentially there's no taxes. I think those guys, you know, that's gender neutral, by the way, who take it early because they think it's going to implode. I just don't think they see the tax benefits that Social Security offers as well. You want to talk about the tax benefits that Social Security offers relative to taking like an RMD from an IRA?
Well, yeah, I would just say that your, you know, Roth and Social Security is what did you call it?
The perfect retirement plan, Elaine. The perfect
retirement plan. Yeah.
If you can plan from 62 to just maximize your RMDs, and at 70 have nothing but not RMDs, but maximize Roth conversions, and then at 70 have nothing but Social Security and Roth. Oh man, you're in such a good place.
Yeah, you barely even need to file a tax return.
That's
no, I shouldn't say that, but
that's
but
right.
Yeah,
you're crazy.
And Medicare premiums.
That's exactly
part of it.
Your Medicare premiums, and then you don't have any tax on
Yep.
qualified dividends, capital gains, the whole thing.
Yep.
You
have to look at the entire picture.
Yes.
What you're going to end up in your pocket after everything, after the taxes and after the Medicare premiums, and just be smart about things. Yep.
I call it the widow's tax trap as well, where a surviving spouse gets left with a large IRA. She loses a standard deduction because her husband's died. She's now in a higher tax bracket, which means she's in the 22% tax bracket with her RMDs, which makes her Social Security taxable more, which makes her income tax at a higher bracket, which can increase her Medicare premiums, make her qualified dividends and capital gains taxes. And it's horrific. And so one last thing is, the thing that makes me maddest is that they haven't raised or indexed the amount of money that is taxed for Social Security. Is there any movement on that you've heard of at all? Since 1983, the same numbers are taxed as they are in 2018. And have you heard anything? Because I find that to be a horrific middle-class tax trap.
It is. And no, the reason we haven't heard anything is that they're actually going the other way. They're doing more to extract money from the higher income people. So they would not and higher income, that includes middle income people
Right, that's
now,
what I'm
of course.
saying. I mean, as widows,
Right.
I mean, widows.
Right, widows. Yeah.
It just it
Yeah.
infuriates me that no one talks about the taxes that you have to pay on Social Security because it hasn't been indexed since 1983. And I've learned all this from you. I mean, I'm not so smart. I know it because and then we'll get out of here. But before I came across, I've been a member of Horse's Mouth since 2005. Before I came across Savvy Social Security Planning, and I was a CFP. If you would have asked me anything about Social Security, I would have no clue at all. I would have said file it early, whatever. And God forbid if you would ask me anything about Medicare before just about 6 months ago, I did not know the difference between Medicare Supplement versus Medicare Advantage. Maybe one day we can have a discussion solely on Medicare. I'd love to do that because, again, these two things are affecting everybody. And the complexity of Social Security is nothing. It's a day at the park relative to Medicare. So I'll just throw that out there. If you ever want to dive into that, I'd love to have that conversation for sure.
Yeah, sure. Yeah, we can do that. And these are things that people tend not to really think about until they're upon them, especially Medicare. There are people age 64 that don't even realize that, everything is going to change for them health insurance wise when they turn 65.
Well, you just did a blog post on open enrollment is upon us. And this guy I talked to, my Medicare specialist up in Michigan, a guy named J.O., he was saying there could be a lot of, given out the mandate and all that from Obamacare is going away. He says there's going to be lots of changes coming down the pike for Medicare Advantage in 2019. It'll be interesting to follow that. And again, 6 months ago, Elaine, I did not have any idea what is Greek to me. And now it's scary because, I've been in the business for 20 years. I got a master's degree, CFP. And 6 months ago, if you would have asked me, I had no clue at all. It's frightening because I'm a professional, and yet how many people are out there don't have any idea? And it's too bad. So that's why I was doing these YouTube videos. Is the stuff that you provide. I just put my voice on there. I just basically say I'm Josh Floyd. I start yapping and using almost verbatim what you say, and it's helped a lot of people. I tell you. The comments I get from people, and again, just in my heart, just surviving spouses, I really, I've always had a soft spot for them, or divorcees in particular, just personal experience, kind of like what you said. But some of the comments I get, it just makes your heart, actually, it makes your heart melt, but also makes your heart break when you hear some of the other comments that, people are living off $900 a month, and just in this day and age, it's just. Last thoughts, Elaine? Not questions. Anything you'd like to say to the group here about what they should be doing? Just anything that jumps out at you. Last thoughts that the listenership should take away.
Yeah, the last thought is to get advice. To see somebody. As I hope that this hour sort of made clear. These rules are so complex, and everything interacts with everything else. And so you just really need somebody who understands. We have a number of advisors who say that, clients came to them because of their understanding of Social Security and Medicare and taxes and all of these things. It's hard to do this on your own anymore. You just really need an advisor, and you need an advisor who will do more than just invest your money. They have to know about all of these programs. So that's what I want to get across to people. Yep.
I could not agree more. A bane of my existence is advisors calling themselves financial planners who just invest money. That's investment advising. That's not financial planning. But Elaine, bless you. I tell you, this is wonderful. I cannot stress enough how much of an impact you've been on my life. I'm hoping I'm paying it forward with some of the people I do on my YouTube channel, and I love it. And I will tell you, you're a national treasure. I'm telling you, the three people we should put on the Nobel Prize for Social Security analysis is you, Alicia, and Kaltnikoff, and that's just rarefied air. So I just keep doing what you're doing. I love it. And I hope you can keep building your Social Security payment by staying employed, because we need you. We need you out there fighting a good fight. So don't let Sean Bailey kick you to the curb anytime soon, please, because we need what you're doing for sure.
Thank you so much, Josh.
Thanks,
I love what you're doing too.
Oh, thank you, ma'am. All right.